sometimes I'm copying you or something, but you just got that up so nicely.
It's all that touch typing skills from throughout the year. But look, let's wrap up this Thursday session. We're joined by Fraser McLeod from Shaw and Partners from beautiful Adelaide. Hey, Fraser, how are you doing today? What has been on the radar? What have you made of today's session?
Well, it's been a pretty flat market, I suppose, really, hasn't it? But I think under the surface this week, it's been what's been clear to me is that surprises can still happen, and I'm not just talking about Scotland thrashing the English in the rugby. So overall this week, what have we been looking at? Well, CIMIC yesterday. Let's handle the pain first of all. So CIMIC yesterday. We were hoping for not an awful lot more from CIMIC, and that simply didn't happen. It was one of those very, very complex and noisy results, I suppose. When you get a new CEO, you hope that they won't do the kitchen sinking, and then it's just too tempting, and they do. So longer term, things will hopefully be better for CIMIC, and hopefully it'll be the case that all that government stimulus spend will translate into monstrous infrastructure construction spend. But market just hated it yesterday. Stock was down. Stock's also down today. It's a frustrating weak hold really for us, and they've just cleared out the balance sheet. They said that the cash flow is going to be pretty poor, and the recovery is not really there yet. So I think more than anything, it's something that the result like CIMIC can really show you that there can be some surprises, even though we have a generally still pretty bullish market.
Yeah, now I know that you said that it was a bit of kitchen sinking by the new CEO. However, we were talking about CIMIC this time yesterday, and CIMIC is one of those companies that consistently, you think it's on the cusp of doing really well because of infrastructure spending or because of a boom in building, and it just doesn't seem to get the act together. So when do you lose faith that CIMIC is going to right the ship?
Sure. Look, you have to have faith that the eventually ultimately CIMIC is a cyclical business, but the cycles are very long, and you want to be able to make sure that you're catching that cycle rather than just getting the tail end of the last cycle on its way down. So it's a frustrating weak hold. I think what we have to look at is that sure that their cash flow was poor. They've said their cash flow was poor because they've got a lot of legacy issues, and it's what's frustrating is that we would expect that whilst they're gaining lots of business, we would expect that would translate into cash flow soon, and they've really basically fessed up to the market and said, well, that's not going to happen yet. Now, it all depends as to how you frame it. On a 6-month view, would you be making money out of this one? Possibly not. On an 18-month view, it does look great value, and that's also the temptation when you're looking around. There is a bit of value there. So you need to be an investor. If you're a trader, you're probably cut out already.
Fraser, this time yesterday, we were talking to CBA Chief Executive Matt Comyn. He was talking about the recovery in the broader economy and starting to flow through to the bank's operations. What did you make of the result yesterday?
Oh, look, it's a great result, wasn't it? It's a magic company, one of Australia's best, and I'm sure Matt's very happy. I'm sure he's probably a bit relieved as well with how the last 6 months really have worked out, because it was only, say, 6 months ago, 9 months ago, certainly, that the provisioning was absolutely massive. These banks were just preparing, just holding on to their hats and preparing to take monstrous losses. And now the losses never came. And it's, what that comes down to? That comes down to just the incredibly super low interest rates that have just turbocharged yet again the property market. And so it doesn't really matter. These banks are entirely reliant on the mortgage market. They're entirely reliant on the property market going well, and it is going well. So even if there are difficulties with some becoming unemployed, you can always sell your asset into in your house if you're forced to, into a very buoyant housing market, and the bank doesn't take a loss. So it's a great company, but it trades on 2 times book value, and 2 times book value here in Australia is very, very expensive when you compare them to the competition. So they are the best, but are they really worth 2 times book value when you can buy Westpac on just over 1 times book value? Are they really worth that 4% yield when you can get 6% yield elsewhere? Look, a lot of people in the market are now sort of starting to question that. So it's a hard business to sell. Most investors will look back on even 8, 9, 10 years later and remind you of the time that you sold out of CBA when you were trying to move money into something that's better value at the time. So we're always very conscious of that, especially as retail advisors. But it's hard to sell, but it's probably even harder to buy at this stage as well. So it's looking pretty pricey.
Especially when you consider that it's so competitive in terms of the mortgage market. The net interest margins are being squeezed in this low interest rate environment that we know will be hanging about until 2024.
Yeah, look, so low interest rates and low interest rates heading to zero are a terrible thing structurally for banks. I mean, it's awful. They don't make any money on deposits, and one side of the business that they used to make money on just doesn't make them any money. So that's going to have huge earnings risk. But the cyclical kicker that's been happening in banks at the moment is very clear, and we're in the middle of it. So it will reach a time, maybe over the course of the next 12 months, that cyclical kicker ends, and everyone's looking around going, well, gee, the structural environment is actually still pretty poor. So no one's making a good dollar on low interest rates, and not a lot of growth coming through in terms of the lending market. And we are very, very, very reliant on the mortgage market here. So yeah, it's a challenge. CBA is not an expensive stock. It's probably better value elsewhere. But yeah, have I been selling it? Look, not en masse.
Mm-hmm.
Fraser, we've covered off the big end of the market. What about the small cap space? Anything has caught your eye recently?
Oh, look, I mean, I'm very happy with how all these uranium trades are going. You know, I'm always banging on about uranium. I do think it's probably one of the greatest reward trades for the future if you're looking for a bit of risk. And if you're looking for here's a nice little chart of about, it was about 10 different uranium companies that I sent, and gave a comparison over the course of the last year. The common theme there, you don't need to be a brain surgeon to work out, is that they're all going up, some of them more than others. The green line and the white line there, that's Paladin and Bannerman, both covered by Shaw's. So, you know, since we started the coverage of both of those companies, they've doubled. They've more than doubled over the course of the last year. We're looking at the Cameco results. So Cameco is the big Canadian and US listed big Canadian company. They're really the largest Western uranium producer. They're the large cap of large caps amongst the uranium producers. And Tim Geitzels, who's their CEO, spoke overnight and gave a very bullish comment for such a large cap, and basically saying, you know, reminding investors that the outlook for nuclear power is a lot more certain. Everyone's turning to green alternative energy sources. Everyone's decarbonizing their economy and committing to that. And 80% of the world's electricity supply is burning fossil fuels. That can't last forever. So nuclear energy is the most cost-effective way to deliver electricity without burning carbon. 24 hours a day, 7 days a week. And so the main attractive element there is that the world on uranium utilities, nuclear power stations effectively, is entirely uncovered into the future almost. So there's between now and 2035, the annual shortfall by the time you get to 2035, which is not that far away if you're owning an asset that lasts for the next 60 years, is £100 million. And that means that you have to discover 6 of the biggest uranium mines that have ever been discovered over the course of the next few years. And currently, we haven't discovered any. So if anything, really, all of the uranium mines, the big ones, are getting to the end of their life. So a lot of earned investment, in fact, no investment over the past 10 years has suddenly come to hit. And that's what the market's facing up to. So very bullish in uraniums, yeah.
Yeah, it's interesting though, because I note that Canadian company we were talking about was up significantly, up about 8%, but we haven't really seen that flow through to the locally listed infrastructure plays today. You know, what comes to mind is always, the likes of Paladin and, some of those other names, Peninsula, I suppose Alligator as well.
True. Over the past 24 hours, I think much of the good news story there was probably already factored in. I mean, Paladin has been a 10-bagger from the low in 2020 so far, and we think it's got an awful lot more to go, probably a good 50% in our price target. Yes, you've seen, I think most of the listed ASX uranium plays did go up today. Paladin did not. But gee, it's been stretching its legs of late, hasn't it? So overall, it's been a market that has been attracting a lot of new money, and not a lot of liquidity in these names. So you need to be pretty careful. But the illiquidity can certainly help you out in the upside as well.
Fraser, it is always fantastic to chat. Enjoy your afternoon.
Good old pleasure. Thanks again.